Today, July 25th, Stride Live. I am joined here once again with Morgan, and we are talking about MSPs once again. Specifically, how to pay yourself the maximum tax benefit as an MSP owner. And who better to talk tax with than Morgan Holmes? How you doing, Morgan?
Great. Good morning. How are you?
Oh, terrific, terrific. Now we got the stream rolling. I'm ready to go. So, just to recap, last week we were talking with Matt Kerrigan around MSP cash flow, making the most of that. Now we want to talk about, okay, your MSP is making a good revenue stream. You have free cash flow. How to set up the organization and different considerations to make the maximum tax benefit as an MSP owner. First and foremost, just with any business, we need to start with the business structure. So, Morgan, typically MSPs are S Corps, but what would you like to say around this business structure as it pertains to tax benefits?
Yeah, pretty much everything we talk about today is going to be geared more towards the MSP that is an S Corp, no matter the size, small to large size S corporation. So S Corp is mostly what we see in the MSP world.
If you remember from 2 weeks ago, we did talk about picking the right entity for your business, professional service, MSPs relating for the maximum benefit. So, MSP owners, you see typically different compensations. If you're an S Corp, I know obviously you have to have some sort of W-2 wages, that reasonable comp. Can you get in a little bit about some of the compensation considerations that an MSP owner should be aware of?
Yeah, so today we'll be talking about everybody's favorite day, payday. And compensation is all pieces of it fit right into that. So obviously the first piece of compensation that most people think of when they think of compensation is their W-2. And so with an S corporation, the first thing to consider for S corp shareholders is your compensation reasonable? A lot of people have tried to play the game where I'll take a small amount of compensation to pay the least amount of payroll taxes, and then I'll take more distributions out of the business. And that actually is something that could lead to some exposure to the S Corp shareholder and the S Corp itself when it comes to payroll taxes. So yeah, first step is we want to make sure that the S Corp shareholder is paying themselves a reasonable amount of compensation. And then once we get past that, we focus on benefits of the employees. Mm-hmm. So, obviously benefits that most people think about are going to be medical insurance, et cetera. But there's other benefits that S Corp shareholders can take as well. So one of those is to the extent that you, when you think about medical insurance, to the extent that you have a high deductible plan, you might also want to consider making contributions to a health savings account or an HSA. It is deductible to the business. For the S Corp, if you have a S Corp shareholder, that S Corp shareholder actually ends up having to pick up that contribution to the HSA in their taxable wages, but then gets the deduction for the HSA contribution on their personal tax return. And so that's obviously a big benefit, for S Corp shareholders. The other benefit of HSAs is that HSAs can accumulate tax-free. And then once the holder of that HSA account reaches the age of 65, he or she can use that HSA for anything. It doesn't have to be used for medical expenses. So, oftentimes what we'll see is people make contributions to an HSA and then immediately start using it for their medical expenses. And, if you can afford to pay for those medical payments, co-payments, et cetera, out of pocket, you're much better doing that than using your HSA.
Makes sense. I want to back up for just a second because you talked about compensation and you said reasonable comp. For an MSP owner or any business owner for that matter, how do they calculate? What does reasonable comp mean? Is it a percentage? Is it a certain minimum threshold? Or is it really a case by case for each business?
It is a case by case for each business. And so when we consider what's reasonable compensation, we look at everything that S Corp shareholder does in the business. Pretty much every business owner does a lot more than just run the business, or there's sales and marketing, maybe some administrative tasks, hiring, purchasing inventory. There's a lot of pieces that go into that. And so when we think about reasonable comp, what we're really trying to figure out is what is that person doing in the business? And if that person had to replace him or herself to do those other tasks, what would it cost? So, and it's also geographic, right? So what it might cost you to hire a sales manager in, Cleveland might be different than here in the Bay Area, right?
Absolutely.
So that it's definitely a facts and circumstances situation. And what we do is we help our clients figure out exactly what it is they're doing in their business, how much time they're doing it, and obviously where it's being performed.
Now, I know you mentioned around too low of compensation. What are some of the considerations outside of, hey, the IRS might be upset if you don't pay it accurately? What are some of the more practical implications, for instance, if you didn't pay enough or pay yourself enough through a W-2 wage as a business owner?
Well, so I mean, the considerations are, you may be, well, one, if you are paying yourself too much, the IRS can come back and recharacterize some of those distributions back as payroll and collect payroll tax. But you might also be over deducting things like the qualified business income deduction. So if you move one piece of your tax return, something else is going to fall out of that. And so it does put exposure on the payroll tax side, and then obviously if stuff gets recast as payroll, then you may be amending your individual tax return for other items as well. So one of the other things too is if you pay yourself too little compensation, your compensation is taxed, the payroll taxes on that, the Social Security, Medicare tax are going to be at a lower amount. You may down the road be finding yourself in a situation where, because you've minimized your payroll taxes, you're now minimizing the amount of Social Security benefits you may get down the road.
Got it. It makes sense. And now I'd love to talk about some of more of the benefits. You mentioned the more common ones, the practical retirement, health insurance. But what are the, like, for instance, fringe benefits? What are some of those examples that an MSP owner might not even realize they could take advantage of from a deduction standpoint, offering
Sure.
fringe benefits?
Sure. So when we talk about fringe benefits or other benefits, that they fall into two categories for S-Corp shareholders. One, a category where it is a deductible fringe benefit to the business and can be excluded by the shareholder on his or her taxable income. The other bucket is it's a deductible fringe benefit to the business and it's not excludable by the shareholder. The two items we just talked about, the health savings account and your medical insurance premiums, are fringe benefits that are deductible by the business, but not excludable by the shareholder because they have to be included on the shareholder's W-2. But other items that fall into the former category, deductible by the business and excludable by the shareholder, maybe things like working condition fringe benefits, a reimbursement for personal use of specific assets, a personal use of your automobile, personal use of your home office, personal use of your cell phone. And to the extent that the S-Corp might have what's called an accountable plan set up, the business could take a deduction for the personal use of that and reimburse the shareholder for his or her personal use items.
Yeah, and my bet's on that pretty much every MSP owner uses all their personal vehicle, their home office, and their cell phone for business activity. It typically does not have separate. So I think that's one that many MSPs might not even be aware of. That's an
Yeah.
opportunity for them.
And even if they are taking advantage of the opportunity,
Mhm.
do they have an accountable plan set up, and are they doing it appropriately? Because the accountable plan just protects the S-Corp shareholder from the IRS saying that those fringe benefits paid to them actually might be taxable income. So it's really just blocking and tackling.
Got it. Now, in terms of retirement plans, there's different opportunities out there. Obviously, the big one is 401k. What are some of the specific considerations for an MSP that says we're making cash flow? We are positive. I'd like to offer that benefit of contributions and retirement plans for my employees. What are some of the considerations from the tax side of doing that benefit plan?
Sure. So obviously to the S-Corp shareholder, if he or she were to contribute to his or her retire or 401k plan, that would minimize their taxable income on their W-2. But what we see a lot of S-Corp shareholders do is contribute the maximum amount to their 401k. When I talk about the maximum amount, I'm talking about the maximum pre-tax amount. So the $23,000 cap in 2023 or 24 rather, or the $30,500 if you're over 50. And that's where they stop. And then they start taking distributions out of the business, and they might take that cash and put it into a taxable account. One consideration might be to not take those distributions, maybe do a profit sharing distribution out of the business. That profit sharing distribution would go into the employee's 401k plan. It's a deduction to the business. You're still going to be putting, that profit sharing amount in the shareholder's 401k, but you now have a tax deferred growth on the amount that you contributed to that 401k.
Absolutely. So it's a kind of a double benefit. Not only can the business owner shareholders have that same plan, they also can deduct it from the business level income, which is further going to reduce the tax liability of the entity.
That's right.
And you said that contribution limits there, it differs, right? If you're 50 or older, there's differences between if you're under 50, over 50 about the maximum amount each year.
Yeah, so the pre-tax contribution limit in 2024 is $30,000. I'm sorry, 23,000. If you're 50 or older, it's 30,500 in 2024. The maximum amount you can contribute pre-tax and post-tax, meaning that the pre-tax amount of 23 or 30,500 if you're over 50. With the profit sharing piece, it could be as high as $69,000 for someone under 50, or 76,500 if someone's 50 or older. So you could really put a lot of money into a 401k plan if you had sufficient cash in the business to do that.
That's incredible too. And so MSPs, if the MSP owners that are over 50, it is not too late, never too late to start saving, investing in that retirement, making sure you have a plan to get there. The profit sharing is a very interesting fact that you can share and distribute profits into the 401k. I think that's actually a very incredible thing that even I was not aware of. Now, in terms of the distributions we talked about, obviously a lot of MSP owners, they take that distribution as a form of income. What are some of the pass-through entity tax credits that they might be available to them? So they've done the benefits, they're offering a comprehensive benefits package. They have the right W-2 compensation. It's reasonable each year. They have retirement plans. Now they're taking that distribution. Let's talk a little bit about that.
Yeah, so post 2018, states started looking at ways for shareholders or pass-through entity shareholders and members to work around this $10,000 state and local tax cap for itemized deductions. And currently about 34 states allow pass-through entities, so S corporations, to make state tax payments to the various taxing authorities. Those state tax payments actually end up being credits to the shareholders, and allow for a federal tax deduction on the S-Corp tax return. So what you end up with is a reduced amount of federal taxable income, a state tax credit that flows out on the K-1, and still allows the individual shareholders of the S corporations the $10,000 SALT cap. So it's a way to work around that itemized deduction maximum for medical or for state taxes.
Got it. You said that was 34 states or 35 states?
Yeah, it's about 34 states right now, 34, 35 states.
Got it. Got it.
Yeah.
That's interesting because that'll obviously maximize the deduction. So, Morgan, we've talked about it now. So, an MSP owner, they have cash flow. That is the biggest consideration of all this. None of this applies if you're not positive cash flow within the organization. It's really hard to have those benefits. W-2, making sure compensation is reasonable. Looking and exploring all benefit options that you want to offer yourself and the employees, and using those distributions and deductions accordingly. Retirement planning, and then distributions. Is there any other consideration to really maximizing the tax benefit for MSP owners that we haven't covered yet?
I don't know if there's a whole, I mean, there are, but I mean, right now we're really just talking about kind of the high level, what we're seeing most for MSPs, their biggest opportunities. I think what you also want to consider here, thinking back to last week's Facebook Live with Matt, is before you take distributions out of your, out of your MSP, you really need to think about how much cash do I need to leave behind to fund operations before you strip the entity of all of its cash. So leave enough cash to continue running your business, and
Absolutely.
that's probably a good thing to do.
Yeah. So for those too long didn't watch, the most important consideration when it comes to cash flow is making sure, as Matt said, 3 months of operating cash flow on hand before you take significant distributions, maintaining that revolving balance so that way you're not worried about making payroll. And then once it comes to compensation, if it's a pass-through entity, S-Corp, it has to start with reasonable comp analysis first. Pay yourself enough as a W-2 employee before you look at benefits, before you look at distributions or any of the other retirement planning. Start from the foundation. Morgan, any 30-second tidbit for the listeners who said, you know what, 15 minutes, a little too long. I like something quick and easy that they can take and use today.
Yeah. So I think when we think of these things, I think you would want to think of these as a waterfall approach, right? So compensation, W-2 compensation, employee benefits being the first bucket. Once you pay yourself and provide the benefits that you need for yourself and your family, move on to, are there other things that we can take out of this business to maximize the benefits that we get out of it and minimize tax. So we're talking about employee benefits, fringe benefits, moving on to funding retirement plans, profit sharing, and then kind of the last bucket in that waterfall are taking distributions out of business.
Got it. So thank you again, Morgan. I appreciate you jumping in on Stride Live. For listeners, we will not be having a Stride Live next week. We are heading to CompTIA's ChannelCon in Atlanta, Georgia. Myself, Morgan, and then one of our other onboarding managers, Larry, will be joining that. So Morgan, once again, thank you for taking the time today for Stride Live.
Thanks, Casey.
You have a good one.
Have a good one.